Hello, and welcome to Quantbeats. I'm Dan Hubscher, Managing Director and founder of Changing Market Strategies and your resource for all things quant. You know my co-host, Rado van Vatko, former 300 million euro quant portfolio manager and current CEO and head of research at Quantpedia. Rado, please say hello.
Hello, everybody.
You can check our backgrounds on the Quantbeats website or in episode 1 of the podcast. Go click the Q logo in the corner of your screen. Today, we're joined by Wayne Ferbert, manager of Alpha DNA Investment Management. Nice to see you, Wayne. Please just say hello.
Yeah, how you doing? Nice to be here, guys.
Thank you. Now, just before we get to Wayne's background and start to find out how decoding sentiment with a quantamental strategy seeks to generate alpha, I need to show you some quick disclosures that are on the screen now. Since I'm a registered representative, we'll be giving you ways to contact me at the end of the episode, and you can contact me with any questions. All right, now let's get to it. For the seasoned investors, aspiring quants, and anyone wanting to dip gently into the world of quantitative finance and give them some insights into quant strategies, knowledge of market dynamics, and a glimpse into the future of algorithmic trading. So to kick us off, Wayne, can you please give us the 1-minute version of who you are, what you do, and how have you been doing lately?
Let's see what I do. I mean, other than the last week's talk clients off the ledge or, convince them to get out of the fetal position. Yesterday helped a little bit, I guess. It's a few days here after the Trump tariffs and the markets have gone a little haywire, but all levity aside, Alpha Data Investment Management, we're a quant-based trading shop or investment management shop. We basically, live at the intersection of machine learning and alternative data. We use alternative data to create more accurate forecasts on revenue and EPS. We basically see demand changes for companies' products before the market does, and we use that research to build smarter portfolios, long portfolios, long biased portfolios, and even equity market neutral portfolios.
Okay, thank you. So that's good for now. We'll get into it a little bit more with each question. So Rado, please, over to you.
Okay, thank you, Dan. So I have first question, and it's the usual question: how you get or got into this quant world? So why quant world? Why machine learning? Why alternative data?
I actually live on the portfolio management side of our business, right? About 10 years ago, I met 2 data scientists. And actually, gosh, time really flies. It's closer to 14 years now. I met 2 data scientists, Rod and Arun, and they said to me, Wayne, if you can track the digital footprint of a publicly traded company, you'll gain insight into who's winning and who's losing. And when you juxtapose that against what Wall Street thinks about who's winning and who's losing, you'll find trading opportunities, both on the long and short side. Now, I had just a few years prior to that left a decade of running product development for TD Ameritrade. And I was one of the biggest internal consumers of the information about how our clients engaged with us, right? And when Rod and Arun said that they were referring to the digital footprint, what they meant was the actual interaction between customers and the digital brands of the companies, right? The websites, the Twitter handles, right? The social media pages. And so I already knew that interaction and the measurement of that interaction was a great indicator of who your most profitable clients are, or even of just whether you're having a good month or a bad month. More interaction generally is positive for any e-commerce type of business, or even these days, any business that has to have a website just to even explain what their product does. So knowing that, being one of the biggest internal consumers of that kind of data at Ameritrade for a company with 7 million clients at scale, right? I knew that what they were saying was going to be a very interesting investment approach, but I knew it was going to take a while to build it. So they left at the time they had a full-time job in Fortune 500 companies. I saw the potential and said, listen, I've got the portfolio management chops, you've got the data chops, right? Let's merge the two and see what we can build. For 10 years now, we've been running live money doing that. And it's exciting. It's cutting edge, right? It's the frontier of where investment management is going, especially the use of machine learning. And also the idea that alternative data can be a proxy for, real engagement and real demand is, I think, a really interesting and unique way to tackle the markets.
I like this answer. I mean, I looked at your web page So I looked at your digital footprint before we started this conversation, and I like the way how you look at this from your perspective. I also consider the alternative data one of the few, let's call it one of the few last venues where we can find uncorrelated alpha, because it's not very crowded and you can mix it together, and there are like a lot of the alternative data sets. You have probably more information about that. So, I mean, what are the important data sets? Because there are like, I don't know, 100 different types of alternative data sets that I can choose from.
It's a great question. So first, we organize our data to 4 categories, right? So there's just the sort of the direct web properties. Think of it as traffic that goes directly to the company's websites. There's search results. So key brands or key terms associated with the company. If it's Amazon, it's, Amazon Prime, right? Or Alexa, right? They have lots of brands. Most people might not realize, though, that they also own mattresses.com, soap.com. A lot of people know they own Zappos.com. They bought that shoe company. I could go on and on. I think they own barbecue.com. There's so many brands that they own. And so those brands matter. We basically track every sort of billion-dollar brand and who's searching for it and why. There's also social media. So Facebook, Twitter, TikTok, Instagram, all those important parts. And then lastly, there's app usage. App usage is actually the newest of the data categories that we track. If you think about when we started actually using this data a little over 10 years ago to invest, we weren't buying any app data for anyone because apps were not the primary way that people engaged with folks, right? And so the data sort of fits into those categories, but it is the consumer metrics and the consumer volume metrics of the actual interaction between the customers and the digital brands of the company or the search for the company. But we don't care about, are they saying nice things about the company? We also don't get any personally identifiable information. We don't know that Rado specifically looked for the company or searched for it. We just sort of, get the aggregated how many people searched for that term, how many people clicked through on it, how many clicked through on a competitor, right? Like that's the kind of consumer metric and volume metric data that we're going to care about. We're always adding more data. We're always taking data out. Data sources go away periodically. But that's sort of the category and clarity data, how that data can be transformed into vectors of marketing analytics. We really solve this problem from a marketing perspective. It's about market share, the slope of your growth. Does it look like your engagement measures are seeing momentum or achieving higher tractions? We turn it into different vectors of analytics. But then the most important part is, do changes in those vectors correlate to past changes in either the revenue or the earnings of the company? That's what really gives us the signal. I mean, that's what machine learning is looking for, and what makes it so capable is its ability to see patterns that the naked eye couldn't see or that regression analytics couldn't see, right? I mean, that's really what we're looking for, is data that's informative around the actual traction that the company is achieving with its clients. And one other thing to add about this is organizing this data is not a trivial exercise, right? I gave it a little bit of example with Amazon. If you want to go buy all this consumer metric data, and we buy it from lots of sources, right? We spend millions of dollars on it. And so if you want to go buy that data, you have to know the URL you're asking for. You have to know the brand you're asking for. Right? And so you have to pass it through an API to the vendor, and they pass it back to you. They don't just give you their whole database. Imagine an entire database of every single URL in the world, the traffic associated with it. It would be way too immense for our systems to handle it. We only are going to pass to them the URLs or the brands that we care about. But these are the URLs that are associated with the app, right? Because remember, apps are just APIs passing data back and forth, right? So it's the URLs associated with those APIs. It is the URLs of the Instagram page, the Facebook page, again, from those apps. It's those key brands, but it's also the web page, the most important parts of the web page, most important parts of the frame. We have a team that just keeps that data fresh. That's always asking, what are the billion-dollar brands at Amazon or Walmart or Target and it's not, I keep mentioning consumer brands, but it's also John Deere, right? Who is mostly going to be a B2B type of provider, right? They have lots of websites related to supporting their products and how people buy their products. There's pharmaceuticals, right? We cover pharmaceuticals. If doctors are prescribing a drug more, there should be more traffic to that drug's website, right? People frequently don't buy drugs online. I mean, it's increasing. The purchase of prescription drugs online is definitely increasing. But still, for the most part, they get them filled at their local pharmacies. Let's say you're prescribed the drug. When you get home, you're gonna go on the website and you're gonna look up what are the side effects, right? How effective is it? You might tell your husband or your spouse. They might go look at it. You might tell your children. They might go look at it. Because that's going to create that sort of traffic. Let's say a drug is just being prescribed more by doctors. That traffic's going to be seen, and that's what we're looking for: is a change in that traffic pattern that correlates in the past to a change in the demand for that company's products.
I have like two questions. I will start with the first one. So the first one is, okay, if you have so many alternative data, do you use also like traditional data, I don't know, price, volume, price trend, past momentum and stuff like that? Or do you see that alternative data trumps those price action or fundamental data? So are the alternative data so good that you do not need ordinary price data? Or, I mean, there is like a combination, so you need to combine those two data sets together.
Yeah, no, good question. The single vendor that we pay the most money to is FactSet, right? But we don't really buy any alternative data from FactSet. So that should sort of answer your question. Traditional data is still a really important input to what we do. It's not the part that's giving us the insight to who's winning and who's losing necessarily. So the data, we buy a lot of fundamental data. Like I said a minute ago, you want to see a correlation between a change in that digital footprint and the change in the revenue or the earnings of the company. So obviously, I need to get the revenue and the earnings of the company from FactSet or from, FactSet's one of the best providers. They're still considered sort of the leading company in the earnings tracking, right? Sort of aggregating analyst views of companies and their models for revenue and EPS. And so we collect a lot of fundamental data from them, right? Sales, revenue by month, by quarter, to the extent companies break it out by month instead of quarter. Obviously, every quarter a company has to announce its earnings. That's a key feed into the comparison, because what we're eventually doing is we're determining, hey, we think Reddit, just as the stock, let's use them as an example. We think Reddit stock, we think their engagement projects to a 9% growth in revenue this quarter. But all the analysts are projecting 4%. So we're at 9% based on our AI models, and the analysts are at 4%. So what we'll do is grab all the data from FactSet, look at all the analyst data, see that they're at 4%. That comparison is what's going to create a buy signal for us. 5% would be a very material gap for most companies. And we're right a lot on our forecasts for those companies. We're traditionally accurate, to a close to 90% for calling surprise in the very tail of what we project, right? The sort of top 5% are most attractive companies. And on either end. And so if we're going to be 90% right and we're projecting it's 9% and the analysts are 5%, that 4% gap's material. We have a lot of confidence we're going to be right. That's what's going to create the buy signal. Or if it was inverted, it would create the short signal. So yeah, we buy a lot of fundamental data. Price and volume is not important to us. We don't engage in a lot of discussion around, is the company trading at a discount? Does it have price momentum down or up? There are no technical analytics, but you should know, this is a really interesting insight, right? You should know there is a high correlation between digital momentum and price momentum, right? So I wouldn't want to be doing extra price momentum work. I'd be doubling down on price momentum. There is already a high correlation between digital momentum and price momentum. It's an interesting insight, right? It shouldn't surprise you that much. If a company is really executing online, it's selling a lot more of its product. The slope of its growth is really improving in terms of engaging people online and therefore selling more products. More people are going to see that. And those are stocks that a lot of investors are then going to start buying and leaning into. We're just good at getting that insight a little bit earlier than everybody.
We are basically looking for a gap between alternative data and traditional data, and you are faster than the others. So there are other people who are doing something similar to you. Maybe they are not using the same data, and it's causing the price momentum afterward when all of the people start to realize, yeah, this is the company, and it will have a great earnings announcement in the future.
Yeah, and in fact, it's even, we don't talk about this a lot, and Dan, you and I didn't talk about this, but I'll tell you guys just now, we don't just analyze the historical patterns of how the company's changes in the digital footprint project to changes in their revenue and EPS. we also look at how changes in the analyst expectations for revenue and EPS correlate to the changes in the digital footprint, right? Meaning, remember, the analyst community is aggressively trying to get at a lot of the same data that we get at, right? And so they're sort of doing a digital channel check also, right? And so one of the things our AI has been trained to do is sort of say, hey, let's find the companies that tend to have a pattern of having information that as it gets into the market tends to move the analysts, right?
Mm-hmm.
The actual objective function that we've designed around is likelihood of analyst change. It's not likelihood of surprise that they'll be surprised at earnings. It's likelihood that the analyst will upgrade their revenue and EPS view. So it's actually revenue or EPS view, but we like to see when they upgrade both. And that is because if a company is going to surprise, there should be upgrades in the build up to the surprise. And then if there's a surprise, there should still be a gap. So there's a high correlation between change in analyst upgrades and the actual surprise event from the company. But remember, every time an analyst upgrades a stock, traditionally it's going to probably be rewarded a little bit. The stock's going to go up a little bit. But we're actually looking for these chances where the analysts are they sort of see the changes too in the digital footprint, but they see them slowly, right? And we see them ahead. And so the AI also looks for that pattern and then tries to, like I said, find the matches. Right?
Yeah. So you are a front-running analyst, basically.
Yeah.
I not directly, but you are trying to outguess them.
We are arbitraging Wall Street analysts.
Yeah, exactly.
There's no doubt about that. Yep.
Okay.
And listen, they move markets, and as long as they're splitting markets, they're a great group to arbitrage.
Definitely. And here is another question. So you mentioned the Deere and industrial companies, etc., but I still think, from what I listened to you, that there will be huge sector differences. So difference between the sector like consumer staples, consumer discretionary, where I can imagine that those data are the most useful, and other sectors that are more B2B, like, I don't know, energy. So do you see these differences or those differences between sectors?
Great question. And we get this question all the time. You should just know that across every single sector, we create consistent stratification between the winners and the losers, right? In terms of beating Wall Street analysts and not. But we also engage in an exercise in which this just is another way that makes us very different than most quants or even most Wall Street investment shops, is we actually score the companies similar to how a credit bureau scores a pool of people, right? When you have a credit score, if you've got a really great credit score, the 800 plus credit score, right? Your score is actually relative to everybody else's, right? The stratification from like the 200 level or 300 level is up to the 800 level is actually sort of like if they were given a pool of people, that's sort of how they would stratify them. So across millions of people, you have that sort of stratification. We're actually creating like a credit bureau approach to how we score stocks. So we score them within market cap, which means, B2B companies are scored against B2C companies. We're trying to find the companies most attractive, right? And so as a result, we are going to find growth companies most attractive. Why? Because I'm trying to find the biggest gap between Wall Street's expectations and what the company's growing at. An insurance company is rarely ever gonna, like think about a company like Allstate. If they have a 5% growth in a quarter, that's huge for them. Like that's, but if the Wall Street expectation was 2, the gap's only 3 points. We regularly find companies in which Wall Street expectation is like 7 and real growth is 15. Right. And so that can only happen in a real growth story or a real growth company. So as a result, we do get more measures in technology, consumer discretionary, and healthcare. We tend to find the most bullish calls there. If I then took each of those sectors though and stack rank the companies, like I said, we still consistently stratify. So if I went into say another sector like consumer staples or finance, right, and banking, I'm still going to find a very consistent stratification between the best and the worst. What really matters is your ability to stratify the two, to call the winner and the loser, not necessarily call that the winner is going to be an absolute winner, but he's going to be a winner relative to the loser, right? And so it's because, like I said earlier, we've got long strategies, we've got long bias strategies, but we also have market neutral strategies. And our market neutral strategies are much more about building pair trades in which there's a winner and a loser. And so even though we sort of score the entire small cap universe, the entire mid cap universe, the entire large cap universe, And therefore, a staples company is compared to a finance company is compared to a technology company in terms of the magnitude of their growth outperformance to Wall Street's expectations, are the ones we're going to find most attractive are going to be the ones with those wider gaps. The reality is within each sector, when you're building a pair trade, you can still find meaningful differences. That's what the sort of statistical arbitrage we're delivering is able to do.
Yeah, I like where we are going because my next question is related to portfolio construction.
Yeah.
So once we have the alpha signal and we have a strong alpha signal, how we build the portfolio? I mean, what is the period for which I should hold the stock? I mean, is it the months or weeks or days?
Yeah, it depends on which implementation, right? In our long strategies, typically the whole time is probably close to 90 days. Remember, every 90 days, a company has to announce its earnings. And so if we're right that there's a gap between the Wall Street analysts and our view, and we were right, the analysts are going to have to change their view and move their numbers up, right? It's that difference is what's going to shake us out of the stock. If we find a company that still has a really big gap and the Wall Street analysts haven't moved up yet, that's something we're going to want to still be long, right? And so, but what happens every 90 days, the company announces, once the company announces and says the word how we're doing and what our guidance is, analysts have to come up. Now, sometimes our best trades are the ones in which we were right, company beats by a lot, the analysts were down here, but the analysts don't believe it. And they go, I think this was a one-off, right? I don't think this company's quite executing. We then look at the numbers for the next quarter and there's still a big gap. And so we stay bullish and then they beat again to the analysts. All the analysts capitulate. When the analysts are wrong 2 quarters in a row, they all capitulate. And you know why they capitulate? Because they're not allowed to be wrong 3 quarters in a row. Right? That's how you lose your job on Wall Street, is to be wrong 3 quarters in a row. And so they capitulate. That capitulation really propels the stock. So if it's a long strategy, typically that's going to be the construct. In our more absolute return strategies, the ones that are pair traded, right? So it's more relative value. Typically, we're going to hold them until the relative value shrinks to our favor, right? Or expands to our favor, right? So those hold times are shorter. There's a lot more risk management deployed in that strategy in the sense of negating away factors. We look for pair trades that are relatively factor neutral, but then we weight our pair trades such that the overall portfolio factor can be as close to neutral as possible. There's sort of a little more effort to neutralize. And by neutralizing that factor exposure, what we're able to do is really just isolate our signal, right? It's our ability to be right versus wrong on those calls because we've, at a portfolio level, we've neutralized away much of the factor exposure.
Yeah. And from the sounds of it, it also sounds like, at least in that market neutral idea, that's where Dorado's earlier question, the traditional price and volume data tends to creep back in as a source because you need that for the comparison.
Yeah, that's right. So first off, when we build the pair trade, we're using a traditional factor model that we license to find pairs that are remarkably factor similar. But they're never going to be factor identical. I mean, think about it, like even Walmart and Target, right? They're very similar, a lot of the traditional factor measurements, like maybe their growth measurements or their balance sheet related measures, right? Quality measures. But they're going to be very different on measures like momentum and valuation. Why? Because price is a key input to momentum and valuation, right? It's amazing how often or how frequently Walmart and Target diverge in price performance, right? So their momentum measures on a factor basis are always going to be pretty different. They're still remarkably factor similar in like many ways that matter. So Walmart and Target, whenever they're really far apart on our signal, would be a really good pair trade, right? But when you enter the trade, you're going to have some net exposure on like a momentum factor, right? Because again, they trade so differently. You'll probably have some differentiation on the valuation factor. So whatever that beta exposure is, positive or negative, right? We're going to calculate it and say, okay, I need to find some other pair trade somewhere that has the inverse, right? Yes. And what we're doing is we're doing it on the incoming 84 days. It's a blind factor study. It's just we isolate on the 7 factors that are most important. They're actually blind factors to us, but you can always bet that market, momentum, growth value, size. The most traditional ones are going to almost always leak into those top 7 factors. But, there's that extra level of risk management, which is why we've been able to deliver what we had planned inside of the risk management design.
And do you see the difference between the longs and shorts regarding the Analyst, etc.? So when you build a pair trade, you have the long leg of the pair trade and the short leg of the pair trade, and I can imagine that there is like a different price action between the longs and the shorts. because the analysts, they tend to differently look on the companies that improve than the companies that are not improving, but are on the other side of the trade.
Yeah, I mean, one of the things about analysts, right, is there is an analyst bias towards bullishness, right? And they don't tend to pile on the stocks that are underperforming. I mean, they will downgrade them if they have legitimate downgrade reasons. It's interesting. Remember, the whole earnings game is skewed in the company's favor. It's not a 50-50 beat game, right? Companies beat on expectations more like 60% of the time because they try to lowball expectations.
Yes,
They try to press them down.
yes.
And so the gap on the top side, right? You would think that would say, oh, okay, well, it must be harder for you to find beats. But the reality is the downside is only going to ever be so far down, right? So we actually tend to find a wider gap on the bull side than the bear side when it comes to beat expectations. So in other words, our metrics on beats are slightly better to the bullish side than the bearish side, but price response, there's no comparison. We will have more separation to the market on a good short trade than we will on a good bull trade, right? Meaning when a company misses, it really gets punished, right? When a company beats, it gets rewarded, but not quite as bad as a company gets punished when it misses.
Yeah, so there is a skew.
Yeah, the only difference being, right, the march to zero still finishes at zero, right? So, but the march up can be more than 100%. But in the long run, maybe the way to think of it is, on average, there's more price separation on the bear side to the average stock than there is on the bull side. But in the end, if it's a pair trade, I just want separation in performance, right? Even if it's modest, that's still a winning trade.
Yeah, so I'm thinking of a AAA analogy here, not the American Automobile Association, but it's sounding like asymmetrical analyst arbitrage is kind of what we're talking about.
Yeah, that's right.
And I'm also thinking of the data collection and cleaning you were talking about, Wayne, at the very beginning when you're explaining how you got to be quant and the jobs that some of these quants do. I'm looking for the mop in the bucket in your background to see if you have one, because if I've stolen this quote from somebody once, I've stolen it 1,000 times. 80% of a data scientist's job is janitorial. And from the sounds of it, there's a lot of janitorial data cleaning going on to figure all this out, isn't there?
Yeah, I mean, luckily we've been doing it for 10 years, so we've automated much of it.
Yeah.
When we first started, just for perspective, when we first started doing it, we had a team of 6 in India that would just, keep our data footprints scrubbed and clean. We don't even have an equivalent to FTEs doing that anymore. We've automated much of it. When you're doing it for 10 years, you get a lot of experience. We mostly just bring contractors on for a little bit of that work here and there, but that's only because of all the early experience with it. But you should know we're onboarding new data. And so there's always something that needs to be scrubbed. And we also always source every data point from at least 2 places to do a quality check on it. It's not uncommon actually for us to find a mistake in the data, send it back to the vendor corrects it for us, but doesn't correct it for anyone else. It's not uncommon. And so that's just the nature of this business. We're committed to quality. We're committed to making sure the data is useful in how it's going to be deployed, because obviously there's a lot of data involved, and the data is going to be what points us to our wins and losses.
You've got an informational asymmetry there as well, sounds like, because if you've got better data or you're creating better data, that gives you not an unfair advantage, but it gives you a competitive advantage.
Yeah, I don't want to overstate that part. A good vendor is going to make sure he's going to fix that data for all future purchasers of it who buy it historically, right? Yeah. But anyone who bought it contemporaneously is not guaranteed to get, that sort of clean data. So we've been doing it a long time, and it's a lot of data, and we're always adding data, and some data even goes away on its own. But there's been data that's been taken private by companies. That's always an interesting outcome as well.
What is the rock star of the data? So what are the popular at the moment? I know that there was a time when everybody was looking for, satellite data. So everybody was looking, I don't know how many cars are on the park lot next to the Target or Walmart or whatever.
It's so many vendors, right, that we buy from. And it's a fairly contained set of data that we buy from every vendor. So although, we ask about lots of URLs. If I showed you the digital footprint for Amazon, how many URLs, for instance, at Amazon we have to ask about because of how many billion-dollar brands they have. I don't know if you guys remember, Amazon built its business early by acquiring every website that sold a lot of product. Like I mentioned earlier, barbecues.com, soap.com, casa.com, right? Diapers.com. If you were like the main deliverer of a product, Amazon probably in the early days probably just came in and bought you. then all of a sudden your website would redirect to amazon.com/diapers, right?
Mm-hmm.
But by buying you, they also bought your sort of your delivery capability, and people just don't realize that that's where Amazon came from. So when you look at their map, it's huge, right? Obviously, the bigger the company, the bigger their map. Apple's got a huge map, right? Walmart's got a huge map. Also, the more they engage with customers online, the bigger the map, right? Meanwhile, does a B2B company have a smaller map? It does. But remember, if you're a B2B company, people still spend a lot of time on your site for service reasons or to research buying the product. Imagine you're going to buy a $150,000 combine for your farm, right? You're going to buy that from the local dealer, or you're going to buy it from a salesman for John Deere or Caterpillar, right? But you're going to go onto their website and you're going to read the manual. You're going to go in message boards. There are Reddit boards where farmers get together and talk about Caterpillars, right? You're going to read the message boards, you're going to read about, and you're going to do a lot of research. If Caterpillar's selling more combines for some reason, because there's more demand for combines, that'll be something we pick up because more people will be going to that site, even though they don't buy it on the site. And so sort of keeping all that data becomes really relevant. In terms of data, you know who moved into the business smartly over 20 years ago was Nielsen, right? Nielsen, the guys who do your TV ratings. They sort of realized more than 20 years ago that advertising is moving online. And what they really measure is that when they were measuring how much commercials you watched on TV, they were really measuring advertising reach, right? So they realized over 20 years ago they had to move into that space. Plus, remember, the companies that sell us advertising space online give a lot of this data away. Like Amazon will give it to you, Google will give it to you, Facebook will give you measurements about key terms, key brands, because they want you to buy those terms, right? So some of the data you can buy, you can just get from some of these vendors. That's not the lion's share of the data. The lion's share of the data you got to buy, right? And it's not cheap. Like I said, we've spent millions of dollars on the data.
Here is another question. So sometimes there is a difference in academic research. So when the academic research tries to explain that some factors work better in large caps and some factors work better in the small caps, there are like two different explanations. So in the small caps, some factors work better because it's harder to obtain data for the small caps and they are harder to arbitrage. And for the large caps, the problem is that the large cap companies are so big that, as you mentioned with Amazon, there are so many different parts of the company that you have a problem to come up with one number that, will explain the whole company. And here is the question. So from your point of view, as you work with alternative data, so which companies are like more inefficient? In a market form. So where are more opportunities, in the large caps or in the small caps? In the large cap because they are harder to calculate, or in the small caps because the data are harder to obtain?
Yeah. So understand, we create alpha in large cap, we create alpha in mid cap, and we create alpha in small cap. But the best risk-adjusted alpha that we create comes from mid cap. And that is because it is the best mix of just enough analyst coverage and just enough digital data, because they're good-sized companies. They're $10 billion, companies, right? And so just the right mix. And also, these are companies sort of emerging. They're not big enough to be in the S&P 500. These days, you can go from being a mid-growth company. Look at like the snowflakes of the world, how quickly they go from being, small. There are companies now, there are examples nowadays, right, of companies that just jump right past. I think AppLovin is one that we've been in for the last year. I think it jumped from the small cap index to the large cap index, right? It never landed in the S&P 500 mid cap index, right? There are so many interesting stories about companies that are sort of executing in that mid range that can become very big very quickly. But we do create alpha in the small cap. But yeah, small cap has the problem of less digital data and less analyst coverage. Will you get the biggest moves in the small cap space? Of course you will, right? They are the more volatile stocks, but you're going to pay for that in volatility, right? On the large cap side, right? Do you still get some pretty good moves? You do, but analysts have picked over Apple. Apple is the most watched company, right? It's the most covered company. NVIDIA might be challenging them for that, but it's probably still Apple. So there's a lot of analyst coverage and there's a lot of digital footprint data. And so, it offers a lot of insight to the digital footprint, but a lot of people are scouring that digital data. And there's a lot of analysts covering it. So we still create alpha absolutely in each of those categories. It's just mid cap tends to be the best. For our absolute value strategies, the relative return, relative value strategies, we actually only focus on the large and mid cap stocks. We don't pull any small cap stocks into those portfolios because of the volatility and because there's shorts in there, right? And Small cap companies can definitely, on the short side, get punished disproportionately. And so for a little bit of risk management reason, it's all large and mid cap. Also, that just makes it more scalable, right? Shorting doesn't scale as effectively across a small cap universe. It scales more effectively across a mid and large cap universe.
This is the long short story. And when you build just the long portfolios and you want to hedge those portfolios, so do you hedge with shorts only, or do you use also the options or futures?
In our long bias strategies, which are hedged, we actually just use index puts.
Just index puts?
Just index puts, yeah.
Mm-hmm.
But luckily, we historically create enough alpha from the long book that it pays for that drag. So you operate with a floor in your portfolio at all times, but it's effective. So which produces lower vol, and yet we still mimic index-like returns with lower vol and an absolute floor in your portfolio because there's a hedge.
So yeah, I understand.
As opposed to most hedge equity strategies, they have lower vol, but they also only capture about 70% of the upside return. We capture closer to 100% of the upside return. 90 to 100%.
Maybe the last question. When you have the long short book and you, combine the longs and shorts and you try to be neutral for all of the factors, do you still see some of the factors that appear for a short time in that portfolio? Like for example,
factors will bleed through. Yeah,
exactly. And also what I'm talking about is like the quant meltdown in 2007 and stuff like that. So, you can be neutral as you want, but something happens, something geopolitical, and it will bleed to your portfolio even that you are neutral.
Yeah. I would say the best way to think about when we deliver the best outcomes versus the worst outcomes is when markets are moving for micro reasons, right? Meaning all the individual stock stories combine to cause the market to move. That's always good for us because we understand the individual stock stories really well, who's winning and who's losing. When markets are moving for macro reasons, right? That tends to be worse for us because, we know which guys are executing, but when the baby's being thrown out with the bathwater, that can be, one of the interesting ones was, but I say baby thrown out with the bathwater, sometimes it can be, it's not just markets going down because that strategy is not correlated historically to equity markets. One of the worst reversals for us was like November 2020, when the news came out that the vaccine was really close, right? Everything that had been a loser that year was like, anything that was low mobility or reduced your ability to get around, right? Those stocks were all the ones that rebounded in that November, right? That sort of whipsaw was indiscriminate, right?
Yeah.
And so it hurt a lot of quant shops, including our view at the time, right? And again, when markets move for macro reasons and news reasons, that sort of thing, that tends to be worse for us than when they move for micro reasons.
I understand. So this is like idiosyncratic factor that's there and was not there in the data for 20 years or whatever.
Yeah.
So
when we look at our long short returns over time, so I told you we licensed one factor model to find companies that are pair trades that are remarkably factor similar. And then we do a whole blind factor study to neutralize the pair trade sort of exposures, right? When all that's done, we actually license a third factor model from a different company, and we analyze the returns and say, what amount of our returns came from factor exposure based on this third model, right? What we find is 3/4 of our return comes from idiosyncratic, it's stock selection. The last quarter does come from factor exposure, but there's no consistent factor exposure.
It changes over time.
Right? It changes. Yeah.
Almost time to land the plane, but let's give a little bit of thought to people who are still new to the topic and approaching quant strategies and artificial intelligence usage. We were talking, Wayne, the other day about some of the basic differences when it comes to AI investing. Like, what's the difference between investing with AI and investing in AI? And how's that changing?
One thing I would say is, if you're an allocator, if you're a person who makes decisions about investing clients' money, right, you need to be asking whether your managers are using AI as part of their process of stock selection, portfolio selection, portfolio analytics. It's the future, right? If they're not, you should be asking them also, well, what is your path to starting to do it, right? I was at a conference recently. I was at a table of 10 people, and I asked them, How many of you are sure that in 5 years, when you do diligence on a manager, you'll ask them a whole series of questions about how they use AI in their selection process? Every hand at the table went up, all 10. And these were 10 allocators. I said, great. How many of you asked those questions today? Not a single hand, right? And I said, well, gosh, AI is already starting to get into this business, right? It's already starting to be used. Don't you think you should probably be asking these questions now? You know, it is the future. Whenever you've got a lot of data, AI can be a great solution for turning the data into better insights, right? And we have a lot of data in the investment management space. And so I think people should be asking how folks are using it. What I found so far is probably only about 10% of investment management companies are actually doing anything really creative and interesting on the real selection side or investment management side. About 80% are using AI to organize analytics or to make their CFAs more productive, be able to cover more stocks and ask more questions, compare different documents to each other, right? 80% of the companies are at least doing that, giving those analysts those tools to make them more productive. But it's not really affecting selection in the sense that the math is doing something predictive to tell you what, which of these companies is going to be a better performer, right? And the last 10% who are doing nothing, those companies are really in trouble. If they're not at least leveraging it for productivity today, there is some old school thinking inside that firm, and they're probably in trouble. So, AI is the future in so many industries. It's definitely the future in this industry. And so I think people need to get trained in sort of how to ask the question about, what are you doing with AI? What's your objective function? How do you organize the data? How thoughtful are you about this? How often does it change? How often do you change it, right? There's a whole series of questions they should be asking in that space. And actually, come meet with us. We'll tell you what we do, and you can use us as the standard to compare to others.
Very good. Okay. Well, it's about time to wrap. So I'm going to say thanks, Wayne. Thanks, Rado, for showing us a bit of the Quant's crystal ball today. So now to meet Wayne from Alpha DNA, or to meet Rado from Quantpedia, or to join us as a guest, or if you're interested to otherwise support the channel, contact me, Dan Hubsher, at these details that are here on the screen. Just note that any questions regarding investment offerings will be deferred to an email follow-up for compliance purposes, as these videos are not intended to be about investment offerings. But if you like this video, please do come back for our next interview with a Quant Manager guest. You might also want to watch the other videos on the Quantbeats YouTube channel. So don't forget to like, comment, and subscribe to Quant-Beats on YouTube. And again, you can get there via that Q logo in the corner of your screen. Or finally, you can visit our websites and YouTube channels for more, shown right here. So thanks for joining. And as always, have a Quant day.
Thank you. Thank you, Ben.
Thanks, guys.